So let's start with the mania. And I think a good place to start is the IPOs, because what we're seeing in terms of AI IPOs this year is extraordinary. What are the big ones, Josh?
So far this year, we've had about $110, $120 billion raised on the US equity market from IPOs. The biggest one by far is SpaceX. A couple of weeks ago, SpaceX raised $86 billion. But to get numbers anything like that total, you have to go back to the boom that we had in 2021. There's been a bit of a drought over the past few years. The key difference between now and then is in 2021, it was kind of dozens or hundreds of companies raising this much money. As I say, this year so far, the vast majority of the capital raise that we've had so far has come from just one firm, SpaceX. And we've got other kind of giga IPOs coming down the line as well. We've got Anthropic, we've got OpenAI. Those are two of the leading artificial intelligence labs. Although we've heard in recent days maybe OpenAI is going to be kind of putting off its IPO until next year. But those are expected to be kind of similar sizes to SpaceX. And any of these on their own would have been the biggest IPO in history. That's probably going to go to SpaceX. But yeah, it's a really long time since we've seen investors this enthusiastic about shoveling money at companies in the equity market.
And much of it retail investors.
Right, exactly. So one of the interesting things about the SpaceX IPO was that 20% of the capital was raised from retail investors. That was actually lower than expected. Elon Musk, SpaceX's founders, wanted a proportion of around 30%. But, even the 20% that retail investors got, that's much higher than you would usually see in an IPO. You would usually see these things dominated by big institutional investors, by hedge funds. In a way, the participation of retail investors is the classic sign that stock markets are shifting from optimism to a kind of more manic phase.
Let's talk about the general context of the stock market boom into which these IPOs are happening. And we've got a chart that shows the AI shares, AI company shares of total market capitalization, how that's shot up since the launch of ChatGPT. And now, flirting with 40% of the S&P 500 is AI or AI-related companies. Mike, what do you make of that increasing degree of concentration in AI stocks in the stock market?
Well, concentration, like the retail mania that Josh is talking about, is one of the things that equity investors worry about. So they look at a market that is ever more dominated by a smaller handful of companies. And I think if you see this chart, you see a fairly large run up in the share of AI companies. This is almost underplaying it to some degree this year. If you had paid attention to equity markets last year, the year before, you would have heard people talk about the Magnificent Seven, the big seven tech companies in the US. This is now woefully out of date. Those seven companies have been joined by three others, not just SpaceX, which is already worth over $1 trillion, but Micron and Broadcom as well, which are chip makers that are vital to AI supply chains. Micron is up 286% this year into $1 trillion valuation. It is nuts how much of the increase in markets this year, that the broad increase has been down to this small handful of names, especially companies that people hadn't really previously priced as important to the AI boom or as crucial as they are now. So it's not just the IPO market. The underlying equity market, I think, is being completely reshaped by this. You are seeing concentration back to levels close to the ones seen at the time of the 2001 dot-com bust. So there is an obvious source of worry there as well.
So is this all completely crazy, Josh? Has everyone gone mad?
Well, actually, for the biggest signs of people going mad, you can look beyond the equity market. You can look at the casino version, which is the options market. Options they're often talked about as insurance, but maybe the best way to think about options is they are leveraged bets that you can buy on the direction stocks are going to go in. A call option gives you the right to buy a stock at a set price on a set date in the future, but it's basically just a bet on stocks going up that you don't have to put a big outlay for. You see trading in options explode when markets have manic periods. We're seeing something quite interesting in the options market at the moment. Usually, options are used as insurance by big institutions. So a put option is a contract that gives you the right to sell a stock at a certain price on a set date in the future. In that way, it can insure you against big drops in the stock market. So the result is that usually put options are more expensive than call options. Bets the market will go down are more expensive than bets that the market will go up. At the moment, call options are a lot more expensive than put options. And what that tells you is that the activity of these whales, of these massive institutional investors, is actually being dominated by people who are just taking a punt on stock markets going up. That's extremely unusual. It's hard to emphasize how unusual that is. And it tells you an awful lot about the kind of mood that investors in general are in.
So we have giga IPOs, we have euphoric stock markets, we have the options market sending signals that investors are ebullient. Mike, we've also got now these companies issuing increasing amounts of debt to finance their investments.
So if you were paying attention to US tech companies maybe a decade ago, you would be familiar with a particular line of attack, which was that these companies generated an enormous amount of cash. They were very profitable. They returned a lot of that to investors, either in the shape of capital gains or in the shape of share buybacks, but they didn't do any real investment. And this was a big worry in the US for a long time. People fretted about the fact that there was no hard investment, business investment by big companies, especially the big new tech companies, was relatively low. That feels like an extraordinarily long time ago now. If you look at a chart of free cash flow, the amount of money many of these companies are making, it's basically aligned straight up for several years, more than a decade, and then it's collapsed now. And it's because they're having to invest so heavily in the AI infrastructure boom, in things like data centers, in power supply, in everything that's needed to actually power this sort of technological revolution. And to do that, they are having to borrow. Again, these companies don't have long histories of borrowing, many of them. If you look at companies like Apple, they're actually relatively recent borrowers. They're relatively reluctant borrowers. This year, they've become major players in corporate borrowing markets. They've issued bonds, not just in the US, but in lots of different markets. And they're becoming an increasing share of investment grade debt in lots of places.